All right, here we go. My guest today is Thor Eakes, CPA. Thor is a seasoned certified public accountant with over 30 years of experience in taxation consulting, financial reporting, and business planning. He's a shareholder at Eakes Company CPAs in San Diego, California, and has advised landlords, business owners, and investors through multiple tax cycles and policy shifts. I asked Thor to come on and discuss how the recently enacted One Big Beautiful Bill impacts real estate investors and landlords. Thor, welcome to the program.
Thank you. Thank you. I really appreciate you inviting me.
I know you're an investor yourself. You obviously work with high net worth individuals, real estate investors. How is the One Big Beautiful Bill impacting investors and landlords for the positive or maybe for the negative?
Well, let's start with the positives. We'll kind of go over that as well. So, first off, as it usually leads on this act, the income tax brackets that were scheduled to go up after this year, they've made, they're going to keep them and remain the same. So that is some pretty good news for investors and things like that, because it keeps the brackets certainly low, and there's a 24% bracket in there that goes on for quite a while that keeps the taxes low for folks on that. So that's the good news. Investors with real estate and things like that, there's a itemized deductions for state and local tax. It used to be capped at $10,000. It is now increased to $40,000. But the trick on that is you need to be aware of the fact that there's a income phase out on that. Usually it's $150,000. It depends if you're single or head of household or married, but there's a phase out on that could phase you back out or phase it back down to $10,000. So so that is kind of good news. We did talk about the income business deduction that you call it the qualified business income deduction. That also stayed in the new law, where you get a 20% deduction for any pass-through income. That I thought would be good for everybody to do that. There was some talk about it going to 23%, but that was extended permanently at the 20% level. So,
if you're like many of my clients who've owned rental properties and apartment buildings for 5, 10, 15, 20 years, you're most likely tired. Maybe you're tired of the tenants. Maybe you're tired of the telephone calls, the toilets, the turnover, the terrible teas. And what you're looking for is maybe a little more time off, a little more travel, a little more tranquility. That's why we've created the new webinar, Mastering the Exit. Sell your rentals, defer your taxes, and reinvest into passive income streams. Spend 60 minutes with us as we cover going into a 1031 exchange and looking into more passive options. Maybe you're looking to reinvest into a net lease asset, or you're interested in a Delaware Statutory Trust or DST, or maybe you have a favorite charity and you want to learn more about the Charitable Remainder Trust. Register for this free webinar. Learn more about what your options are so you can get away from the terrible T's and focus more on the terrific T's.
for those people that do cost segregation studies and all that, 100% bonus depreciation is back, so that is very favorable for people who buy real estate and do a cost breakdown on that. Increases the depreciation and everything. So that is a kind of a big change that everybody was looking for. Now, with folks that have a lot of real estate, the estate tax exemption is now at $15 million. That's effective January 1st, 2026. So it's 15 million per person, 30 million a couple. So there are plenty of estate planning techniques and strategies about gifting, certainly real estate, limited partnership interests, and the like, to your kids and beneficiaries. So it gives us a lot of room on that. The other things that have come on is certainly for the seniors that are 65 and over. There's an extra $6,000 deduction for seniors, and if married couple is both 65 or over, you get a $12,000 deduction. And so that too is something that people can take advantage of. One of the things that hurts folks, certainly those in California, but any high real estate states, the mortgage interest limitation remained at $750,000. So that's something that everybody has to deal with when they make not investing purchases, but home purchases. So that's something to keep in mind on that. I know you touched a little bit before we started about the energy credits, the clean energy credits, and for the most part, that is going away after this year. And the clean energy credits. So there's going to be a little bit of a rush between now and the end of the year to get any sort of clean energy type things. I've already been receiving calls about getting solar put on people's homes and stuff like that. So and commercial properties and such. So another thing too is for anybody who has a car, the car loan interest now is deductible up to $10,000, so that's pretty good. You will get a 1099 or 1098 from the auto loan folks. That'll have the requirements for registration, VIN, and things like that that has to go into your tax return. So that is how things have shaked out with real estate. Now, another thing that's coming up here is the opportunity zones, and we can talk about that a little bit. Opportunity zones are alive and well, and they're offering, once again, another deferral technique where you can show a capital gain really from any source besides real estate, stocks, privately held companies, and such, and you can invest the proceeds into these opportunity zones and defer the gains on that. So that is something that is going to be a new opportunity. That was no pun intended, but they were closing out the opportunity zone in 2026, but now they have extended that as well. So for those who might not understand, opportunity zones for the most part are federally designated areas in and around the country. Every city has a designated opportunity zone. You can find that online. And they're encouraging people to invest into these areas, mostly for rehabilitation and things like that, and rehab. So the idea is for the real estate or the proceeds being invested into real estate, and then that real estate being developed. Normally, they like to have 100%. Investment on the with the improvement. So if a piece of property is $500,000, they would like to see an additional 500,000 improvements to that property, those properties to improve that area. So there's a lot of opportunity on that.
And Thor, can you expand a little bit on that? Because I know people get confused. I know my clients do. So let's say they invest the million, 500 to purchase, right? Is that what you're saying? And then 500,000 to improve, and that money, say, came off of another sale. If they hold it for 10 years, does it eliminate all capital gains tax where they don't have to do an additional 1031 exchange? Is that the benefit of that program, or do I have it mixed up?
They have, you get a permanent exclusion, okay, for any post acquisition gains if the zone investment is held for 10 years. So using an example, we sell something and there's a gain of $1 million. That goes into the opportunity zone. Okay, you got a 5-year deferral on paying the capital gains on that. And I believe there's a 10% discount on that will be paid in year 5. And then any appreciation from the date you get into the opportunity zone past, and then if you hold it past 10 years, all the appreciation from that period is tax-free. So
it's the new gain that from the new basis is
right.
tax-free. So you can essentially roll in an exchange into an opportunity zone,
Right.
and then anything new above and beyond you roll out, and there would be no gain, no capital gain.
That's right.
Got it. And now have they extended those permanently, or is there a new deadline?
That has been permanent. That's been permanent. So
That's a really big deal because when people think of opportunity zones, they don't realize that 92103 San Diego has areas that are considered opportunity zones. Many of the big cities.
You'll be a little surprised, and just because you live in, I live in San Diego, there are opportunity zones around the country, and so you can invest in other parts of the country if you think that areas are worthwhile. So I do have some people that maybe they're have really a lot of knowledge in a particular state. Let's take Utah, for example. And so they'll understand that certain companies are moving into a particular area, and the opportunity zone, which is in where the businesses are moving into or adjacent to them, will make it quite lucrative to develop in that area. So that's something that is happening all the time now. So, but yes, you'd be surprised what you consider an opportunity zone. So you got to jump on the website and see where they are in the various cities and get a feel for it. So
sure, maybe for the investors or the landlords that are coming out of active management in San Diego or wherever, the ability to go into a fund, because you're not investing in opportunity zones individually. It's usually in some sort of a fund, correct?
Right, that's correct. So usually a group has an LLC where the funds are invested into the fund, and then they make the acquisition of the real estate, and then they have the plan in place to do the amount of rehabilitation or improvements that they need for to qualify for the gain deferral. Yeah, and there's some pretty interesting projects, especially if you're having large employers come in, or government, state and local, that kind of stuff, and could really benefit from it. So it's quite an incentive.
The old saying is, you do a 1031 exchange, like Bill Exler likes to say, you swap till you drop. You swap until there's a step up in tax basis. Unfortunately, someone has to pass away
Right.
in that regard. Is this a good alternative to that if they were swapping and in essence the primary seller, the investor, doesn't have to pass away, he can roll it into an opportunity zone and eliminate his gain, or does it not work that way?
Well, he doesn't eliminate the gain as much as he defers the gain. On 1031 exchanges, the stress point is, you have 45 days to identify the property and then 180 days to close, everything being equal. And sometimes it's difficult to meet those deadlines. So,
right.
The other thing you can do is sell the property, and then you have 6 months to invest in an opportunity zone from the date of sale. So it gives you a little bit more breathing room on what you can do. And again, this is not take my gain and put it in 1. You can take your gain and put it in 3. Different parts of the country, that kind of stuff. Maybe different types. Although I see more residential real estate being invested on this, but there's others you can work on as well, mixed use and stuff like that. So you can spread it around a little bit, and some people find that attractive. It just depends how big the gain is, and what the investment minimums are. So
interesting. I can see how those would become very valuable, especially since people were getting concerned that they were going to shut them down in 2026.
Right. Right.
Let's circle back to the business income deduction and bonus depreciation, because I think that was one of the hottest topics, at least for a lot of the investors I'm hearing about. And maybe you can break it down a little bit on how it works. How should landlords, the standard independent landlord, be thinking about cost segregation to boost their cash flow?
Okay, let's take, I can give you a couple of examples. So let's say, for example, you want to invest in a fourplex, okay, somewhere in the country, and it's an $800,000, fourplex, okay. And what you can do is that you can perform a cost segregation study that will break down the components of that purchase. Okay. Now there are various buckets inside a piece of real estate that qualify. You have 5-year property, you have 7-year property, you have 15-year property, and then for residential you have 27.5-year property. So once you go into this analysis, as I call it, it'll break down to those 5-year property, 7-year property, 15-year property, and 27.5. The beauty of bonus depreciation, and we can immediately expense the 5-year property, the 7-year property, and most of the 15-year property. So if you don't do that, then you're stuck with having to depreciate everything over 27.5 years. Of course, you don't get to depreciate land, but it really accelerates the amount of depreciation you can take. Now, commercial properties, if you're into that, it's the same concept, but instead of having a 27.5-year category, you have a 39-year category. And normally when it goes to commercial properties, everything being equal, there are more components in the 5-year, 7-year, and 15-year buckets. Not saying you don't get anything on the residential side, but you certainly get it there in commercial as well. So sometimes people kind of shy away from the cost segregation study because they're a little expensive if you have folks do them, but there's other types of methods that you can do that'll break down the components on smaller deals and get some benefit on that. So Yeah, a lot of deduction up front, shelters all your rental income, could shelter a passive gain if you have it, and some other property and things like that. So it's pretty advantageous to do a cost segregation study on pretty much every property, so that you can do.
Yeah, that was going to be my question. The smaller landlord wondering if I have a single family duplex, triplex, fourplex that's residential because it doesn't have all the fixtures and
Right.
things that a commercial property generally has, but they still have air conditioning units, things of that nature, right? And those can all be broken down and depreciated in the short term.
Right.
So you're saying you would recommend as a strategy that regardless of the type of property, it's an investment property, they should do some sort of cost segregation study in order to
Right.
take advantage of the benefits.
That's correct. Yeah, I think having those expenses up front are great. Sometimes a lot of us investors have passive loss carry forwards that are just kind of sitting there and going on, and it's just a nice thing to have if all of a sudden there's a gain or somewhere else that you can take the losses against, or sometimes if the losses are accumulating inside a piece of real estate, sometimes we just want to exit that property, and that triggers the whole thing at once. Um, so that's the thing I want to do. Some of the skeptics will come by and say, well, I get depreciation anyways, and that's true. You can do it ratably over 27 and a half years or 39 years, but it's most of the time it is pretty advantageous to get your deductions up front and save on tax. So,
Sure. Yeah,
so
absolutely. And so
yeah,
what does 100% depreciation mean? Was there a different percentage prior to the change in this bill?
yeah, the bonus depreciation was at 20% as of 2025. So we got an 80% increase on that. It has been ratcheting down the last 3 or 4 years. Now, there's another type of depreciation out there called Section 179 depreciation, and we were able to gain some benefit on that, but it wouldn't drive losses for the properties like bonus depreciation would. So we were very glad that bonus depreciation was back. So didn't get a retroactive, unfortunately, but be as it may, we have it now. So
And the other item you touched on was the qualified business income deduction. Maybe you can expand on that a little bit. I know that very few, but some of my clients hold their properties as, just as an individual. And my assumption is that by holding it in some sort of entity wrapped around it, they're going to get a better deduction. Is that correct?
yeah, normally the way it works is this qualified income business deduction is that you get a 20% deduction on the property against the profit. Okay, so for example, you can calculate the profit for a particular business or entity, and then you calculate the 20% deduction based on the amount of property you have, the wages you have, and that comes up with basically a 20% deduction, and that would flow through and cut down your potential profit on that property. So I'm glad that stuck around too. So that's kind of a big one. But yeah,
The other item you kind of touched on was the SALT deduction.
right.
How does that apply to real estate investors, and how did the bill change impacts on landlords and other folks that are in the real estate field?
Well, taxes themselves are capped at $10,000. That includes your state income tax, real estate tax, personal property taxes, which for the most part is DMV registrations, things like that. So to get up to $40,000, it was very helpful to do that versus $10,000. But there is an income phase out on that. If your income is over $150,000, there's a better than average chance it's going to be revert back down to $10,000. So that's something that you need to be aware of. So that's how that works. So
Got it. Now, did the bill affect interest deductibility rules?
What I touched on earlier is that we're still capped at $750,000 for home mortgage interest. We did get the car loan interest of $10,000, but there really wasn't any sort of limitation on what I call investment interest. Rules are basically the same. Any sort of rental real estate interests and things like that. So.
Now, this is off real estate, but I have to ask, and maybe you don't know, but I know they put a provision in there where there's no tax on tips, and I always like to ask the folks that are served. We were out to dinner last night, and I was asking the gal, "Are your tips getting taxed?" And one gal told me that there was some restrictions. If you made X amount, that your tips did get, in fact, still taxed. Do you know anything about the results of that, or where that played out?
Yeah, and basically, a person who customarily receives tips in their job, as I call it, and we'll just use restaurant servers as an example. Okay, they're going to get a breakdown on inside their W-2 about what portion of their W-2 is tips, and they will get a deduction for that. Up to $25,000 is the cap. So that's a bonanza for the food servers to do that, and so that's a good idea. Now there's also no tax on overtime, which is kind of interesting because now you're going to have to, on the W-2, what portion of your wages was overtime, because then you could get a tax deduction on those folks as well. So there's going to be some, and this is kind of interesting because, July 4th was when the bill signed, but it's back to all of 2025. I just don't know if payroll is going to, have that set up where they can separate that. So here at our firm, I do pay overtime for those who are non-exempt employees. So and we record it as that. So I'm assuming there's just going to be a separate line item in everyone's W-2 to who get that, so they can take their deduction. So that's something that needs to happen. But those are two benefits as well. So.
It seemed like there were quite a few benefits in this bill for folks. A lot of promises kept. Any standout negatives from the bill that you're anticipating? I mean, other than the fact that they sure do keep you CPAs on your toes with all these changes in the tax code.
Well, yeah. We were, President Trump did mention the idea of not getting taxed on Social Security. Really gave us a charge there for a while, but unfortunately that did not come through. The consolation was the $6,000 senior deduction that everyone over 65 received. So, as my dad would say, it beats a sharp stick in the eye, but pretty much everything beats a sharp stick in the eye. But yeah, so no Social Security. That was a little bit of a bummer, and is probably the biggest disappointment. So on that. But everyone would like to have lower rates, would like to do that and everything. I'm just kind of going through if there was any else on here that was kind of a bummer. But the biggest one was Social Security. Yeah, and we can talk about the Trump account if you want. We can talk.
Sure.
About
What's the Trump account?
The Trump account, okay, is an account that's going to be set up by the federal government that anyone who has newborns in 2025 on, it has to be newborns, will get a $1,000 investment by the federal government into a Trump account. Now, everything I've read said it has to go into the Index 500, the S&P Index 500. And that money, and then, parents, grandparents, whoever else, they can start funding that as well to do that. And then starting in 2026, I think, and on, there's a possibility that employers could contribute up to $2,500 into that account. And
That's a big deal when you think about an infant having $1,000 investment with compounding interest over time. Is the idea, well, incentivize folks to have more babies because we need
yeah,
them, and secondly, the idea that with compounding interest, someone turns 25 and $1,000 invested 25 years ago, they'll probably be doing pretty good 25 years from now.
right. So if you think about it, this year the government will do 1,000. Mom and dad or grandparents can start feeding that as well. And then if the employer can put in 2,500, that's a pretty big deal. And so, and I'm assuming all of that still has to go into the Index 500, as they've mentioned that, or the S&P 500. So stay tuned on that one. But yes, that's a big one, and everything. So yeah, the Trump account.
Interesting.
Yeah.
So maybe we'll skip into some as we wrap up here. Some generalities. You're an independent real estate investor.
Yeah.
Anything you want to share, just as sage advice from a CPA for investors or new investors, maybe folks looking to make their first investment or turn their current home into a rental? What would be your sage advice to pass on to investors in 2025, Thor?
Okay. Well, the first thing that that you want to do is really understand the rules when you get into real estate. Is the real estate going to generate passive losses, or is the real estate going to generate active losses? A lot of these short-term rental investments are being counted towards being an active loss versus a passive loss. So you can have that in there, and being able to do that. So that is something I always tell. Do you have an Airbnb? Do you have an ADU? Because then what you want to do is if you have your home in the front and an ADU in the back, we can treat that as a short-term rental loss and apply that against any and all your income. If you have a rental in the front and the rental and a short-term rental in the back, you want to split that out and do that. So a lot of it is in that regard splitting out. So some of my real estate investments, I have a long term in the front and the short term in the back, and we were able to convert our garage to an ADU here a few years ago. So that provides an advantage there. And then of course you can do the cost segregation study, things of that nature, and generate more losses that way. So that's probably the first one to talk about. And I'm looking forward, hopefully, to seeing some lower interest rates. I think that'll spur more investment. I mean, right now, I think the world's a little stubborn on lowering their prices. I've seen some go down, but certainly not here in sunny California. They've been kind of sticking to their guns a little bit, and I don't blame them and everything. So I kind of get that. But I'm hoping with the lower rates, that'll give everybody some ability to, invest. We talked about cost segregation, so I like doing that. Another thing you got to keep your eyes on is, the latest thing in San Diego is they're going to start charging everybody for trash. And if there's any other like that in any other parts of the country, you have investments, but trash is a big one. That's already starting to come through commercial properties as being a new reimbursement. But for the residential tenants, that is going to motivate the landlords to increase their rents a little bit. But you need to keep your eyes on how that is billed to you and how much it is. So right now, as I understand, it's going to go through the property taxes. And everything. So you're supposed to break that out by looking at it's just not all property tax, but it's trash as well. So from a rental investor standpoint, you got to do that. So we're trying to find opportunities to increase our rents when we can without disrupting, our investment. So that's a little bit of a trick today. So, but that might be the case in other parts of the country. So.
Yeah, I would agree with that. And maybe looking into a RUBS program for the water, because that cost is going up, trying to build that back to the tenants, because you have, of course, the restrictions in Southern California in general of your restrictions. And I'll say, as we kind of wrap up here, my number one piece of advice is to have folks sit down with a qualified CPA like yourself that understands real estate investing and is not just working on paperwork and every year. And there's a few great ones, you being part of that crowd in San Diego. Many of you I've met through the Provisors Network, and even some great folks that do cost segregations in that group. So, yeah. Thor, as we wrap up, where can people reach you if they want to learn more about, how you might be able to help them going forward with some of these tax strategies, or, your firm in general?
Well, you can always send me an email at Thor, Thor, at Eakes, Eakes, CPAS.com, or call my office at 858-332-4201. So. I love talking real estate. It's great, and see what else is, what else we can talk about. So,
absolutely, and Thor, I always love the fact that you introduce yourself as the spiritual leader of Eakes Company CPAs.
That is me.
That's always been such a hit, and I want to thank you for coming on and talking with us about real estate and the new big beautiful tax bill. I'd like to invite you to come back on in the future as we go forward, and we'll put your contact information in the comments below. And of course, out there, if you found any of this helpful, please hit the like button, subscribe to the channel as we try to bring more content, and share this episode with other investors and landlords that could use this great information. Thor, thanks a lot for coming on, and I appreciate your time today.
All right, thanks a lot.